Good morning. This is Andy Cates from the Global Economics Department at UBS. This weekend's G7 and IMF get-together has yielded some agreement about what needs to be done to stabilize financial markets. And the reaction to the noise so far across Asia has been a tentative thumbs up. We've seen a G7 action plan that agrees in principle to ensure liquidity in the interbank funding market, the recapitalization of troubled banks, deposit insurance, and the protection of major financial institutions. Australia and New Zealand have chipped in as well over the weekend and launched their own plans to safeguard their systems. Politicians across Europe either are about to or will shortly announce much more detail about the specifics of their plans. We know that the UK government will announce, or is currently announcing, a £46 billion injection to bail out RBS, HBOS and Lloyds. The US has admittedly been a bit quiet and on the sidelines through much of this, though Treasury Secretary Paulson did say this weekend that pumping government funds into the system was a top priority. As a reminder, the macro research group at UBS has laid out a number of elements that we think need to fall into place before we can be confident that the crisis can and will be resolved. And they include things like government-sponsored recapitalization and things like deposit guarantees, along with what we saw last week, namely coordinated action from central banks. Policy, therefore, has arguably been moving in the right direction and will probably continue to do so. The issue that sadly many are probably uncomfortable with is whether many of these initiatives are arriving too late to prevent a large-scale deleveraging of private sector balance sheets in the period ahead, with all that implies for economic growth. There's still a great deal of concern, for example, that much of what we've seen rightly addresses the systemic problems that exist in the financial sector, but there's not that much on the table that's going to turn around the US housing market, and indeed other major economies' housing markets in the period ahead. And it has, of course, been the bursting of housing market bubbles, most notably in the US, which has arguably been the fundamental genesis of the problems that we now confront. Analysts' consensus earnings expectations, meanwhile, even now have not adjusted to the darkness that will probably pervade the global macroeconomic environment in the period ahead. And that, of course, still presents a major hurdle for those anticipating a sustainable market recovery in the weeks ahead. Our asset allocation group is hopeful that markets will bounce if policymakers follow through with action plans over the coming days as extreme levels of risk aversion in the market unwind. Fundamentally, however, they remain cautious and guarded about the macroeconomic and market environment over the medium term. As for the week ahead, note that the US bond market is closed today for the Columbus Day holiday. On the economic front, the schedule this week is quite busy, with the highlight probably a speech by Bernanke on the economic outlook on Wednesday. Otherwise, the calendar includes a great deal of data, with forward-looking and, in ordinary circumstances, market-moving properties. Markets, though, are likely to remain focused on government action plans, along with indicators of market stress, most notably in the money markets. Further unscheduled rate cuts, meanwhile, are possible in the days ahead, should those indicators remain as stretched as they have been, and particularly if other markets, and most notably equities, remain gripped by fear. That's all for today. Thanks very much.